The latest economic data paints a picture of an economy walking a tightrope. Newly released figures show U.S. growth unexpectedly accelerated in the spring, with output rising at a healthy 2.8% annual pace. But lingering inflation means policymakers must continue their intricate balancing act, taming price pressures without tipping the economy into recession. For the Federal Reserve, the second quarter report contains an intriguing mix of crosscurrents. On the one hand, the growth figures indicate the economy retains more underlying vigor than many forecasters anticipated. Personal consumption expenditures, the main driver of GDP, grew at a solid 2.3% rate, suggesting the American consumer remains relatively resilient despite higher borrowing costs. This robustness provides the Fed some breathing room as it calibrates monetary policy. With demand still firm, central bankers can afford to stick to their regime of interest rate increases for a little longer, confident the economy can withstand the strain. After more than a year of assertive credit tightening, the Fed wants to see clear and sustained progress against inflation before pausing their campaign. Yet the latest data also hints that the Fed's inflation-cooling efforts are beginning to bite. The PCE price index, a closely watched gauge of underlying cost pressures, slowed to a 2.9% annual rise, down from 3.8% in the first quarter. While still too high for policymakers' comfort, the deceleration in core prices signals the economic brake imposed by past rate hikes is starting to bind. This moderation in inflation opens a potential path for central bankers to navigate the oft-discussed soft landing, suppressing price pressures without crashing the economy into contraction. With inflation gradually abating and growth holding at a decent, if slowing, clip, the Fed may soon be able to pause its rate increases and revert to a more wait-and-see posture. As ever with economic forecasting, however, the outlook is clouded by countervailing forces. Unemployment has now risen for 3 straight months, an early harbinger of cooling labor demand. Residential investment, a bellwether of housing market health, contracted as the cumulative weight of prior rate hikes struck the mortgage market. And while business investment surged last quarter, earnings reports from corporate titans like PepsiCo and Nike suggest the American consumer may be reaching the limits of their tolerance for high prices. For the millions of families struggling under the burden of escalating rent, grocery, and gas bills, the latest GDP numbers likely ring hollow. Yes, the headline growth rate accelerated, beating economists' projections. But any relief in the cost of living crush remains elusive. After a year and a half of rampant price hikes, real disposable incomes have declined for 24 consecutive months, leaving the finances of many households increasingly strained. As I've traveled the country over the past months, interviewing citizens from all walks of American life, one lament recurs: the ever-widening chasm between the economy's statistical vital signs and the lived experiences of average workers and consumers. Whether in the office parks of Silicon Valley or the farmlands of Iowa, kitchen table budgets feel tighter despite the sunny GDP reports dribbling out of Washington. The resilience underscored by the new growth numbers is impressive, a testament to the dynamism that still courses through the national economic corpus. But resilience is not the same as vibrancy or flourishing. For a people battered by 2 years of rolling COVID disruptions, followed by the stiffest inflation in 4 decades, simply withstanding the economic storm is a hollow victory. What's needed is not just a tolerable degree of growth and inflation, but a renewed sense of economic rejuvenation, vigor, and optimism. A reawakening of the uniquely American traditions of entrepreneurial daring, social mobility, and middle-class membership that have long set this nation apart. For too many, those ideals have receded behind the gray gauze of malaise. Each month's mortgage check or supermarket run feels more onerous. Each child's future seems to hang in greater economic doubt. The Fed's well-laid plans for a soft landing ultimately ring hollow if the mass of citizens fail to derive meaningful benefit and regained prosperity. The high-wire balancing act continues, with central bankers gripping their inflation-fighting tools, watchfully assessing each incoming datum through narrowed eyes. But at some point, their maneuverings must spark a more palpable revitalization, not just sterile statistics, but a renewal of the deep economic vitality and social mobility that represents America at its best. Else a hollow victory looms, and the masses will be left wondering what use were such Herculean efforts if the fruits remain stubbornly ungraspable for all but a fortunate few. As Niebuhr reminded us, nothing that is worth doing can be achieved in our lifetime. Therefore, we must be saved by hope. Now is the hour for the Federal Reserve and this nation's economic stewards to replenish the reservoirs of hope on which the American dream ultimately rests.